Every trend has its beginning and its end. Here we've had the uptrend that later is turned into a downtrend. And as simple as it looks to be, most traders don't actually understand the trend they're trading and how to position themselves in case the market is reversing. In this market, on the 1-hour chart, we're having this downtrend price action. Then when the market pulled up to the upside, it broke above the past high, so you would call this a trend shift since we went from lower highs to now having the first higher high. But this isn't an actual valid trend shift because it only broke with a wick. For an actual valid trend shift, we need a candle closure above the previous high. This is a very important factor because if the market wicks above, it not only shows that's not a valid reversal, but it also indicates a higher probability for a trap or liquidity sweep. So traders are getting fooled by this break and start entering buy positions and so on. But later, we see that the market continued to the downside one more time, breaking below the previous low, holding lower lows for one more time. And it's only then when we see an actual valid trend shift, when the market pushes higher and now actually breaks the past high with the candle now finally closing above the past high. This is an actual market structure shift. This trend shift reverses this entire price action that was initially in a downtrend, now turning into an uptrend. When doing the market analysis, you want to gather as much information as possible. We can easily do that by zooming out, so we can see more price action data. And in this case, we initially have an uptrend on this entire price action structure. And the whole market that you can see on this chart is simply just a high time frame uptrend, because if we mostly check the swing levels, we have a swing high, then a pullback to the downside. Now the market is looking like it's about to move into a higher high, breaking the past swing high. So I'm marking the swing levels, and now knowing this information, we come back from where we started, from this downtrend. Well, now we know that this downtrend is just a pullback of the higher time frame trend. And when a downtrend ends by a break of the past high, the pullback ends and reverses into an uptrend, basically aligning with the high time frame trend, being an uptrend. So this market structure shift is an internal shift, not an external shift. For an external shift to happen, the market would have to break the swing high from above, and not only this one. But this internal trend shift is a major indication that that market can soon go there, since we should move higher. So if we know that there is a higher probability of moving up, we look for potential levels for buy positions. They are usually demand zones because they act as support levels. Demands are located as the last downside candle before the upside impulse. And this price action must have caused the break above the past high, basically validating a higher high. This is important because if we do not have a higher high formed, then the demand will likely not hold. Now we have two options. If you're a swing trader, you can use the first high time frame validated demand as an entry. So basically using this demand as the setup as it follows, the entry on the demand, with the stop loss below the demand. And the take profit usually goes above the past high. But in this case, this leaves us with a lower risk-reward ratio. But what we can do is target higher levels. And to do that, we need to make sure we understand the market's price action, every single important detail, especially the higher time frame trend. The reason we could target the swing high is that this market's price action is an uptrend. We have the upwards push with a pullback, the pullback ending once the internal trend shifts from a downtrend into an uptrend. So it would make sense that we would have a higher high on the swing level, and this keeps holding as the uptrend continues. So we can try above the swing high. Having a decent risk-reward ratio, however, is still not so high, but it's the most the current market condition allows us. The market fills the demand, opening the order, and reverses to the upside very quick, eventually breaking above the past high, going straight into the take profit, and even much higher. So this internal price action that caused the trend shift is very important, and more specifically the price action that comes right after, which looks to be a pullback to the downside. But some traders see this as a downtrend, and they're right, sort of, but it's an internal downtrend inside an external uptrend. And what a lot of traders do is that they see, for example, a break of this low as a bearish break of structure. So what they would do is they're looking for supply levels to sell the market down, but this is a huge mistake, since they're basically trading against the higher time frame trend. And especially a bigger mistake is that they're selling when a valid demand is very close to the current price. And they keep doing this again and again, from every supply they can find. And you see what happens next. Well, the market finally fills the demand. Then the market aggressively breaks above their supply, stopping them out. This is why it's very important to prioritize the structural levels from the higher time frame. The high time frame trend always has priority. That means that this demand is way higher quality than any supply you would find as long as the market is holding an uptrend. Which it did, because we had this upwards push. Now we can simply just leave this market, or we can wait for more price action to form, and we look for new opportunities, if they appear, of course. So after the initial upwards push that broke the past high, we've got a small pullback to the downside, then a continuation into a higher high. So far nothing out of the ordinary, since it's simply just a continuation of the uptrend, by forming the higher high, the higher low, then the higher high once again. And of course, when the past high breaks during an uptrend, that's a break of structure, which also is confirmed only if the market closes above the past high with a candle. And now the same process repeats. The break of structure validates a demand. The demand is the last downside candle before the upside impulse started to happen. Now, as I mentioned before, we have two options. Considering a swing trade, we just trade this demand with a buy position. It's what we did before. But now the second option would be scalping this setup, and we do so by lowering down time frames. This is the same market, same time, just seen on the 15 minutes chart. This is the demand from the 1 hour chart. And to refine even further, we look into the details where the higher time frame demand was formed on this entire price action. By doing a quick analysis, there is this initial upside push that breaks and closes above the previous internal highs. Then we get a pullback and continuation of this internal uptrend. So here, for example, there is another confirmed demand, and that it also filled here, and we see that it respected, having this massive gain in bullish momentum. But if we're analyzing the swing levels, we had the initial first push, then the pullback that formed the demand, and a break above the past high, which confirmed that this demand is valid. So even if the demand filled on a lower time frame on this internal price action, the confirmation that the demand has a high probability of respecting comes only after the market actually confirms that it holds an uptrend by breaking above the past swing high. In this case, where we have a higher high, we would then look for a higher low, basically the swing levels of an uptrend. And the upcoming higher low should not break below the previous one, and the previous higher low is this one, which is attached to the demand. So it makes sense for the market to respect this demand, because if we're thinking that it won't respect, that means that we want a break of the low, which would mean that we want a downtrend. The problem is that we don't have anything to consider a downtrend yet. So it might be smarter to trade with the trend instead of trading against it. So similar as the previous setup, basing it on trend continuation, we're placing a buy-long setup on the demand, with the stop loss below the demand, which is also right below the previous low. As I said, it's a more conservative stop loss placement, because if the market would actually break below this level, then we would have a trend shift into then forming these lower highs and lower lows. But so far, we don't have any bearish signal, so it's too early to take a downtrend into consideration, so that's the logic behind the placement of the stop loss. And the logic behind the take profit should be placed above the swing high, since on an uptrend, the swing levels are forming higher highs. And as we see on a lower time frame, on scalp setups or intraday setups, the risk-reward ratios are usually higher. Now we pretty much just wait for the market. Here the internal downtrend begins, which fills the demand, opening the position. And since it's been quite a long time since the previous swing high is formed, it becomes more dangerous to keep the take profit there. You can still target the extreme highs, but if you're more conservative in terms of the risk, you can limit your take profit down to the recently formed swing high, which still has an incredibly good risk-reward ratio. So basically, right after filling the demand, it got pretty close to hit the stop loss, but the market reversed by the middle of the demand, going straight into the high, breaking the last swing high like it's nothing. And now you just apply the same theory, because the break forms the break of structure, and this might validate another demand near the lows. So the market could pull back to the downside, just to fill a demand from where you can use multiple concepts to properly identify higher quality setups. A lot of these concepts are used by my members. You can check it out on the link in the description as it helped many traders, and it should help you as well. Have a great trading week.